An old proverb states that imitation is the highest form of flattery. This undoubtedly pertains to investing. Monish Pabrai, a renowned investor, puts it more bluntly. He asserts that it is acceptable to borrow investment ideas from reputable investors. In fact, Monish calls this shameless cloning in his book. In this video, we'll engage in a little of that alleged shameless cloning by examining the stocks that super investors are planning to purchase in 2022. Stay with the video all the way to the finish because you never know what you might learn that you can apply to your own portfolio. But before that, make sure to subscribe to the channel and hit the bell icon for more amazing content. Let's get started with this video now without further delay. Number 5. Amazon. The stock with the ticker symbol AMZN that our group of super investors purchased the most was Amazon. One of the biggest firms in the world, Amazon has a startling $6 trillion market worth. Absolutely trillion with a T. In 2021, the corporation generated a total revenue of $470 billion. This was a rise in revenue of about 22% from the year 2020, which, as you are aware, was a tremendous year for internet shopping because everyone was cooped up at home. One of Amazon's most amazing qualities is its ability to develop so quickly despite its enormous size. Typically, when a company grows bigger, its growth rates begin to slow down. In terms of money, more than 50% of Amazon's revenue comes from online sales. Over 20% of sales came from services provided by third parties. 15% of its revenue came from the rapidly expanding and very profitable cloud computing platform AWS. The remaining revenue is made up of advertising, subscription services, and physical stores. At the moment, Amazon is selling at a PE ratio of roughly 70. When compared to the S&P 500, which is presently trading at a PE ratio of about 23, it appears to be a fairly high number at first glance. But at the start of 2018, Amazon's PE ratio was almost 250 times higher. Another thing to keep in mind is how quickly Amazon's earnings are increasing. In fact, over the following few years, the corporation is expected to triple its earnings. The corporation reported $46 in earnings per share in 2021, and by 2025, it is anticipated that this figure will have risen to nearly $132. Its PE ratio has drastically decreased since. Despite Amazon's enormous growth over the past 18 months, its stock price has remained steady. At the same price it did in the summer of 2020, it is currently trading at almost $3,200 per share. Number 4. MasterCard. The ticker symbol for MasterCard, MA, is next on the list. One of the most well-known brands in the world is MasterCard, yet surprisingly few people are aware of how the business actually generates revenue. Most people think of credit cards when they think of MasterCard. MasterCard does not truly consider itself to be a credit card firm, despite the fact that the MasterCard name is one of the most recognizable in the world for debit, credit, and prepaid cards. Fees paid by MasterCard's clients, who are regular consumers like you and me, account for a sizable portion of the company's revenue. Instead, financial institutions like banks that pay a charge to issue credit and debit cards are MasterCard's customers. The company's market valuation with the MasterCard name is $340 billion, and its PE ratio is approximately 42 times. The cost of maintaining a payments network does not include any investment in tangible property, such as factories. MasterCard generates a lot of cash flow as a result. The business actually generated $1 billion in free cash flow in 2021. This represents a free cash flow margin of 48% at $8 billion in revenue. Let's compare that to another company with a similar market cap, Home Depot, to get a sense of just how high that is. Home Depot earned $151.2 billion in revenue last year and $14 billion in free cash flow. This represents a 9.2% free cash flow margin. This only serves to demonstrate how lucrative MasterCard's business strategy is. Additionally, investors place a high value on this. According to an old proverb, cash is king, but for stock market investors, cash flow reigns supreme. Number 3. Meta Platforms. Our group of super investors is buying Meta Platforms stock, which trades under the ticker FB. Maybe you're familiar with it under the name Facebook. On this list, this stock is perhaps the second most contentious. Some people believe that this stock is an absolute must-buy, while others believe that it will continue to plummet. The lone stock is more divisive. The last stock on this list that narrowly missed a beat is the Meta. For what it refers to as its quote, family of apps, Meta is most recognized. Facebook, Instagram, Messenger, and WhatsApp are a few of these. Almost everyone who has access to the internet uses one of these apps, which have more than 3 billion monthly active users. The majority of the company's revenue comes from the sale of adverts to marketers. Its advertisements give advertisers the ability to target customers based on a range of criteria such as age, gender, geography, interests, and behaviors. As you can probably guess, the ability to target potential customers based on certain qualities makes these kinds of investments extremely helpful for businesses wanting to sell goods or services. From its peak in September 2021, Meta stock has fallen by more than 40%. Investors are worried that competitors like TikTok are luring users away from the family of applications. Investors are also concerned about a shift in social media towards short videos like TikTok and Instagram Reels. The number of adverts that social media businesses can sell won't be as high as before. Investors are also very worried about the corporation losing billions of dollars because Meta is placing such a large wager. The business division of Facebook Reality Labs, known as the Metaverse, which includes consumer devices and software for augmented and virtual reality, lost $10.2 billion in 2021. The stock price fell as a result of these worries from a high of $380 per share in September 2021 to less than $200 per share in March 2022. As a result, from 35 times in 2017 to 15.7 times today, the PE ratio has decreased significantly. This has a lower PE ratio than the S&P 500, and because of this low PE ratio, many investors believe the company is too cheap to pass up. Number 2. Visa. Visa is the next stock that a group of super investors are purchasing. I won't go into too much detail on Visa's business strategy because it's remarkably similar to that of MasterCard, which we previously examined. In their respective markets, Visa and MasterCard virtually hold a duopoly. An industry is effectively controlled by two large players in this situation, and every other company is vying for the small portion of the market that the two large players do not control. In the soft drink sector, Coca-Cola and Pepsi are other illustrations of a duopoly. According to statistics I found while doing research for this video, Visa and MasterCard together account for 90% of all credit and debit card purchases. Visa holds over 60% of the market share in the US, while MasterCard holds about 30%. There isn't another industry that comes to mind when the top two competitors have such a significant market share. The price of a share of Visa stock is currently around $220, down from a peak of almost $250 in summer of 2021. You may recall that MasterCard has a market cap of $340 billion. The market capitalization of Visa, on the other hand, is approaching $500 billion, which represents Visa's higher revenues due to Visa's greater market dominance. Visa is a money-making machine as well. Visa reported $25.5 billion in revenue and $14.5 billion in free cash flow in 2021. This astounding free cash flow margin of 56.9%, which is higher than MasterCard's and, to be honest, is perhaps the biggest free cash flow margin of any business I have ever encountered, is quite astonishing. This is due to the fact that, given the income that the company generates, the operating costs for Visa's operations are quite low. This enables the business to make a ton of money. Number 1. Alibaba. One of the most divisive stocks I've ever seen is the next one on our list. This argument has two opposing sides. The stock is viewed as having a considerable risk of dropping to zero on one side and as a once-in-a-generation buying opportunity on the other. Alibaba is the name of that stock. The biggest e-commerce corporation in the world, Alibaba has been compared to the Chinese Amazon. A well-known investor has placed a sizable wager on the business. The renowned Charlie Munger is the investor in question. It was one of the first equities Munger had purchased in recent memory, and it was notable enough that I prepared a complete film about it, which you can view here. The argument in favor of Alibaba is rather simple. China has 1.4 billion citizens, making it truly an enormous nation. Additionally, when China's economy expands, each of those 4 billion people will have, on average, more money to spend. According to that theory, businesses like Alibaba will profit enormously as the economy and country get wealthy. Alibaba's revenue increased by 58% in 2018, 51% in 2019, 35% in 2020, and 41% in 2021 as a result of how this has played out so far. The valuation of Alibaba stock is yet another factor that investors would use as a compelling argument to purchase it. With a market cap of $290 million and a PE ratio of just 15, Alibaba is currently trading. Compare that to Amazon, which has a market cap of nearly $1.7 trillion and a PE ratio of 69 times. The bears, on the other hand, are present. These are individuals who would sell the stock instead of investing in it. they would contend that the stock is discounted for a purpose. For many investors, the Chinese government represents the biggest risk when investing in Alibaba. The peak price of Alibaba stock was roughly $310 per share in October 2020. Since then, the stock price has fallen dramatically due to regulatory worries. As of the filming of this video, Alibaba stock is now trading at about $100 per share. That's it, guys. These were the 5 stocks that the super investors are buying in 2022. Which one are you opting for? If you like this video, make sure to subscribe to the channel and hit the bell icon. Leave a like, share it with your friends and families, and jot down your thoughts in the comment section below.